Have you ever wondered why some people seem to build wealth effortlessly while others stay stuck no matter how much they earn? What if I told you it all comes down to one skill most beginners never learn: how to allocate your assets the right way? Today, you're about to discover how to master this essential skill and avoid the mistakes that silently keep millions broke. But here's the twist. Most people think asset allocation is only for the rich. Is that really true? Stick around, because the answer will surprise you. Number 1. Why asset allocation matters more than picking the right stocks. When people think about investing, they usually imagine picking hot stocks or the next big thing. But here's the truth. Studies show that more than 90% of your investment returns over time come from how you allocate your assets, not which stocks you pick. Think of your money like a team of players. If you put all your players on one side of the field, you're likely to lose. But if you spread them across defense, offense, and special teams, your odds of winning skyrocket. For example, imagine Bob puts all his money in stocks. When the market crashes, Bob panics and sells at a loss. Now, Sarah splits her money between stocks, bonds, and cash. When stocks crash, her bonds hold steady, and her cash gives her flexibility to buy stocks at a discount. Who do you think ends up ahead? That's why asset allocation matters. It's your plan for surviving storms and growing your wealth over time. Number 2. The 3 main asset classes you must know. To start allocating your assets, you need to understand the 3 basic categories you can invest in: stocks, bonds, and cash. Stocks are ownership in companies. They're like a roller coaster: fast, thrilling, and sometimes scary. Over the long term, stocks historically return about 7 to 10% per year, but they can drop 30 or even 50% in a bad year. Bonds are loans you make to governments or corporations. They're steadier, less exciting, and generally give you lower returns, around 3 to 5% per year. But they help cushion the blows when stocks drop. Cash includes savings accounts or money market funds. It doesn't grow much, often less than inflation, but it's your safety net when you need quick access to money. A healthy mix of these 3 is what keeps your money growing while protecting you from disaster. Number 3. How to figure out your risk tolerance without guessing. Here's where most beginners mess up. They hear someone say, "Be aggressive, you're young." So they throw all their money into stocks, then lose sleep at night when the market drops. The truth is, risk tolerance is personal. Here's a simple example. Jenny is 25 and plans to invest for the next 30 years, but she panics every time her portfolio loses 5%. On the other hand, Mike is 40, but he's calm even when his portfolio drops 20%. See, it's not just about age. One easy way to test your risk tolerance is this. Imagine you invested $10,000. If the market fell by $2,000 in a month, would you feel calm, nervous, or would you sell everything? If you'd panic, you need a more conservative mix: more bonds and cash. If you'd stay calm, or even buy more, you can afford to take more risk: more stocks. Number 4. The 100 minus your age rule. Does it really work? You've probably heard this classic rule: subtract your age from 100, and that's how much of your portfolio should be in stocks. The rest should go into bonds and cash. For example, if you're 30, 100 minus 30 equals 70. So you'd put 70% in stocks and 30% in bonds and cash. It's a decent starting point, but it's not perfect. If you're comfortable with more risk, you might go heavier on stocks even as you age. If you're very cautious, you might want fewer stocks even when you're young. Think of this rule as training wheels, not the final destination. Number 5. Rebalancing, the wealth builder nobody talks about. Here's a powerful secret most beginners miss. Your asset allocation doesn't stay the same over time. Imagine you start with 60% stocks and 40% bonds. A year later, stocks do great, and now there's 70% of your portfolio. That means you're taking more risk than you planned. Rebalancing is when you sell a little of what's grown too big and buy more of what's fallen behind. For example, after your stocks grow to 70%, you sell some stocks and buy more bonds to get back to your original 60 to 40 split. It might feel weird to sell what's winning and buy what's losing, but over time, this discipline actually boosts your returns and lowers your risk. Number 6. Why cash still deserves a place in your plan. Some people say cash is trash, but that's not always true. You always need some cash on hand. usually 3 to 6 months of expenses. This is your emergency fund. For example, if you lose your job or face a big medical bill, you won't need to sell stocks at a loss just to cover bills. Even investors like Warren Buffett keep billions in cash, not because it grows, but because it protects them and gives them flexibility to buy opportunities when others are panicking. Number 7. Diversify not just across assets, but within them. Here's where beginners can level up. Don't just buy stocks. Own a mix of large companies, small companies, USA stocks, and international stocks. For example, if USA stocks fall, but international stocks rise, your losses are cushioned. Same with bonds. Own some government bonds and some corporate bonds. Maybe even some short-term and some long-term. Think of it like not putting all your eggs in just one basket, but spreading them across many baskets. Number 8. What about real estate and other alternatives? You might be wondering, should you include real estate, gold, or even crypto in your allocation? Here's the short answer. Yes, but carefully. For example, owning a rental property or a real estate investment trust, REIT, can give you income and diversification. Gold can protect you when inflation rises. Crypto is much riskier, but some investors put 1 to 5% of their portfolio into it as a gamble. For beginners, it's best to focus first on stocks, bonds, and cash, then add small amounts of alternatives as you gain experience. Number 9. Automating your asset allocation so you don't mess it up. Here's the best part. You don't have to do all this manually. Many beginners use something called a target date fund. For example, if you plan to retire in 2050, you can choose a 2050 target date fund. It automatically allocates your money and adjusts it over time as you get closer to retirement. Or you can use a robo-advisor. You answer a few questions about your goals and risk tolerance, and it builds and maintains your allocation for you. This way, you avoid the temptation to tinker and make emotional decisions. Number 10. The biggest mistake to avoid. Here's a mistake that costs beginners thousands. Doing nothing. Some people say, I'll wait until I make more money, or I'll figure it out later. But every year you wait is a year of lost growth. Even investing just $100 a month in a balanced portfolio can grow to over $150,000 in 30 years. The best time to start was yesterday. The second best time is today. Number 11. How often should you adjust your allocation? One question beginners often ask is how often they should adjust their asset allocation. The simple answer is once or twice a year is usually enough. For example, you can pick 2 dates, maybe your birthday and the first day of the year, and check if your allocation has drifted. If it has, rebalance it back to your target. Trying to adjust every week or month just creates stress and can lead to bad decisions. Number 12. Why time horizon changes everything. Your time horizon, how long before you need the money, should guide how aggressive you are. For example, if you're saving for a house in 3 years, keep that money in cash or very safe bonds. But if you're investing for retirement in 30 years, you can afford to put much more into stocks and ride out the bumps. Always match your investments to when you'll actually need the money. Number 13. The role of inflation in your allocation. Most beginners forget that inflation silently eats away at your savings. For example, if inflation averages 3% a year, your cash loses value over time. That's why you still need stocks and other growth investments to stay ahead of inflation. Even though cash feels safe, too much of it can hurt you in the long run. Number 14. Don't forget about taxes. The way you allocate your assets can also save you money on taxes. For example, keeping bonds in a tax-advantaged account like an IRA is smart because bond interest is taxed as regular income. Meanwhile, you can keep stocks in a regular brokerage account, since long-term capital gains are usually taxed at lower rates. A little planning here can mean thousands of dollars saved over the years. Number 15. Start small and build confidence. You don't need thousands of dollars to start allocating assets. Even $50 or $100 a month can get you going. For example, you can open an account with a robo-advisor or buy a low-cost index fund that holds a balanced portfolio. What matters most is building the habit and learning as you go. Over time, you can increase your contributions and fine-tune your plan. Building wealth isn't about chasing the hottest stock or waiting for the perfect time. It's about making a plan, sticking with it, and letting time do its magic. Now you know how to allocate your assets in a way that protects you, grows your money, and builds confidence over time. But here's something to think about. If you could only invest in one thing for the next 10 years, what would you choose? Let me know in the comments.